Good afternoon, everyone. Welcome back to Profit Matters. This is lesson 2, take 2. Sorry about for those of you that attended last time, we had some technical difficulties and were unable to complete the webinar. And so we decided that we would just go ahead and redo it. And hopefully we won't have those technical issues. We've got those worked out. I tell you, this is great technology that we have that we can do these types of things, but sometimes everything don't go just as you plan it. And that's what happened last time. So again, hopefully we've got those technical issues worked out and we'll have a good session today. Welcome to everyone. We're glad to have you on board this afternoon. And my name's Steve Abernathy. I'm the CFO of the World Floor Covering Association. And as I said, this is Profit Matters. It is part of our overall Studio 59 platform that we do webinars and host training and other things with. And again, it's great to have everyone on. Again, we've got several that are joining us and continuing to join. And we hope you get a lot out of today. Just again, ground rules for those of you that hadn't been on the sessions before. This is generally, for the first part of it, a one-way presentation. I'll be talking and taking you through the material that we're going to look at this afternoon. And then at the end, we'll have time for questions that you can submit via the chat portion of Zoom. So if you would just submit your questions in there and they will come to us at the end. I'll be glad to answer as many of those as I can. If there's an answer that I don't have, I'll be glad to get it for you and get back with you later on it. If you're watching this recorded, which we do record these and we do post them on our webpage, then you can submit those questions to us and we will be glad to answer them after the fact. So with that, I'm going to go ahead and get started without any further ado, and we'll just dive into some of the materials here that we are going to look at today. The lesson today is titled Gross Margin, a Deeper Dive. And just as a quick review, the last session that we did, we looked at some basic financial concepts and terms, particularly as it relates to the two major reports that a business uses to evaluate the performance of their business, and that being the income statement, otherwise known as a P&L, a profit and loss statement, and the balance sheet. And on the P&L, we look at things that have transpired over a period of time. So we're looking at, a month, a quarter, a year, something along those lines, a span of time in the activity of the business for that time period. And we look at revenue, both operating and non-revenue, non-operating revenue, the cost of goods sold. And then we, of course, look at expenses, operating and non-operating expenses. And the net of those two, between revenue and cost of goods sold and expenses, all bring you down to profit or income. And there's gross income and net income. Gross income, we're going to get more involved in today in today's lesson as we look at gross margins and how we calculate gross margins and how we impact gross margins through business decisions. But we have both gross and net profit. So that is a difference. The gross profit is simply the difference between the revenue and your cost of goods sold. And then, of course, your net profit subtracts expenses from that. Now, on the balance sheet side of the equation, we have things that we own and things that we owe. And this is as of a point or a date in time. So this is as of month end, quarter end, year end, that sort of thing. And on the balance sheet, you have assets, which are the things that you own. You have both variable and fixed assets. You have liabilities, the things which you owe, both short-term and long-term. The net of those is the equity or the net worth, if you will, of the business. So those are some basic concepts that we covered in the last session. And we're going to continue down the learning on all of this and dive down into more of this as we get going. And as I said, on today's topics, we're going to look at gross profit. Particularly, we're going to look at the concepts and terminology around gross profit. We're going to look at markup versus margin. This is a very, very important topic. And it is oftentimes these two terms get used interchangeably. They are not interchangeable, in fact. And they often, one gets used when the other should be used. And so we're going to look at some formulas around that, how to calculate each of those, and look at some examples of how that changes the overall profitability of the business using one or the other. And then we're going to look at calculating your selling price of your goods based on a target gross margin, what you're trying to achieve there are formulas that we can use, real simple formulas that get you to the proper pricing of those goods on the floor so that you make sure that you get the correct margin. Then we're going to look into our benchmarking tool, and we're going to look at some margin norms for the industry. What are the averages out there that we can compare ourselves or benchmark ourselves against? And then finally, I think probably the most important piece is looking at where margin leaks. I call it margin leaks. It's basically an opportunity where margin gets away from you, from some practice that you do or some things that impact you that you may not be aware of that you need to look for to make sure that you don't leak margin in your business. So those are going to be today's topics as we get further down into it. And so I'm going to start right away with these gross profit concepts and terminology. So in some of the concepts that we have here, these terms, one of which is selling price. That doesn't take a whole lot to define that. You know what that is. It's the price at which you sell your goods or services. And by the way, as we go through this, be aware that we're talking about the sale of product, which is flooring, it could be carpet, hardwood, whatever it may be. But it also includes selling of other things, supplies. It may be, you sell supplies to installers, for example. Those are all part of margin. They're part of your sales dollars. And also the services that you sell, in addition to things like cleaning services or maintenance services or things along those lines. One of the most important things you sell is labor. And we're going to talk a little bit about labor, and labor is certainly something that impacts gross margin. And then the second term is the purchase price or cost, and we'll look at some of that in detail. It's not always just the price, $10 a yard, whatever it may be, that you pay for a square yard of carpet. It also includes other costs that go into that in terms of your purchase price. You have freight that's involved in getting that product to you. That is generally part of the purchase cost of the materials. And then you have a term called net sales. Net sales is your gross sales, what you book as a sale minus some things that get deducted from sales to reach net sales. We'll look at that in particular as we go through it. And then cost of goods sold. Cost of goods sold has multiple components to it. It seems real straightforward. It seems like your cost of goods sold is really just, what did I pay for the product? If I paid $10 for a product, then that's my cost of goods sold. Well, it is at the very bottom product level. But when you bring it to your financials and you start to look at cost of goods sold in terms of gross margin, there are other components of the cost of goods sold that have to be accounted for. And we're going to talk about those in specific as we get to that part. And then, of course, your profit. Your profit is expressed either in dollars or in cents generally. And then we'll talk about some percentage things that you look at in profit as well. But profit as a dollar is how much you make in terms of dollars from your selling price minus your cost of goods sold, essentially. And so we'll look at that expressed in dollars and cents. Then we have two terms, as I said, that often get confused. We have markup. Markup is expressed as a percentage normally. And we'll look at the formula and how do you calculate markup. And then margin is either expressed in dollars or percentage. More oftentimes, it's generally expressed as a percentage. And we'll look at those formulas and how do we calculate those as well. And then you've got, again, goods and services. I mentioned before, you've got more than just product sales. You have product sales, you have labor sales, you have supplies, and then you have all the services that you might perform or do in your business. So when you're looking at both the revenue side and the cost side, all of those sales of goods and services play into your overall gross margins and also the profitability of your business. So that's some general terms and concepts. Now let's look at a few more very specific things. I said we'd look at net sales. So net sales is the net dollars that you receive for the goods and services that you sell. And it is your gross dollars. You start really with your sales dollars, what you sold in total, that you book for all the products and services that you sell. Basically just add up the sales receipts. And the bottom line of that is your sales dollars. But you have to subtract to get net sales. That's gross sales. To get net sales, you've got to subtract some things from that. One is returns. So if your customer returns something to you, then that is a return that needs to be deducted from your gross sales amount to reach net sales. They brought it back to you. You may record your gross sales, but you want to know what your net sales are, so you've got to take those returns out. And the returns shouldn't be just booked back against your sales dollars. They need to be kept up with on a separate line so you know what percentage of your sales are actually returned to you. So it's important to track these things individually on your general ledger, and your accountant should be able to do that if they're not doing it today. And I'm sure they probably are. And then the second thing that gets deducted from gross sales is allowances. An allowance is where you have somehow accommodated your customer for something that you generally did wrong. It's probably an error on your part, or it could be, on the manufacturer's part, if it's a defect or something like that, where you're providing a discount or an allowance because of some defect or error that occurred. So you have to take those out of your sales. So if you credit them back $100 as an accommodation because the dog got mad at the installer, I don't know, whatever it might be, you give them an accommodation there and an allowance for that, that gets deducted from your gross sales. And then finally, sales discounts. And you might think, well, my sales discounts are taken up, out of my sales to begin with. Well, you really shouldn't do that. What you should do is set your selling price for your goods, and that's how you should book that on your sales ticket. And then if your salesperson provides a sales discount, maybe you're running a 25% off sale, or they are given the leeway to deduct an amount as a discount to close the sale, for example, you should track that separately and individually, because you need to know how much of that is going on, and you need to be able to validate if you were running a 25% off sale that your sales force didn't go in and give 30% off, for example. So tracking your sales discounts separately from your allowances and obviously from your sales is a way to track what's going on in your store. And again, as we get into look at some of the opportunities for margin leaks, those are two of them, I would tell you right out of the gate. So net sales is simply gross sales minus those three items: returns, allowances, and discounts. And that gets you down to net sales. And that's the first component to calculating gross margin. Now, let's look at the second component to get to gross margin, and that is the cost of goods sold, affectionately known as COGS, if you in accounting terms. And cost of goods sold has multiple components. As I said, it's not as straightforward as you might think it is. For one, you start out with your cost of your materials itself, the actual price that you paid your supplier for those goods, or in the case of labor, for the labor services that you have sold. So with that, though, that's not the only cost. You need to add some items into that and subtract some items from that to get to your true cost of goods sold. The first thing you add is your freight in. Now, freight out is a different thing. If you look at the freight that you pay, if you do ship something to someone, let's say you do online sales, for example, and you ship a product to a customer, that's different. That's freight out to customer, not freight in to you. In cost of goods sold, freight into you is a part of that. So when you pay a supplier, so much a square foot or so much a square yard or some flat rate you pay UPS or FedEx to get goods into you, that is part of your cost of goods sold. It's called freight in. It needs to be tracked separately, and it goes into an add to your cost of goods sold. It increases your cost of goods sold. Addition to that, if you're selling labor, of course, your cost of goods sold not only includes the product cost of materials, but the labor for your subcontract labor that you have paid to get that product installed. And so that is a component of cost of goods sold, because remember, at the top line on revenue, you are recording your product sales as well as your labor sales dollars. So you want to also include your cost of those two items in your cost of goods sold. Now, the third line item there, installation in-house labor, is oftentimes missed. In fact, there probably is some debate as to whether it's part of cost of goods sold. I would argue that it is, and the most proper way to account for that is to include that in your cost of goods sold, because you're including the labor revenue. You should include the directly associated labor cost so that you properly get your margins on both the product and the labor sales. And so if you don't include in-house labor, if you simply expense that in salaries and wages down below your gross margin line, you're missing the true gross margin comparison that you should have to basically evaluate whether or not you're making money on labor as well. And so in-house labor and benefits associated with in-house installers should be swept up to your cost of goods sold when your reports are done. And again, your accountant should be able to do that for you if you track that labor separately, as you should from, say, your sales labor or your warehouse labor, for example. Those should be captured and brought into your cost of goods sold. Your supplies, this would include for a particular job. These are job supplies, not office supplies, but job supplies, something specific to installing the flooring. So it may be adhesive, it could be tack strip, it could be seaming tape, it could be whatever materials that you supply to the job, or in the case of in-house installers, those things that you give your in-house installers to go do a particular job. Ideally, you would cost them directly to each job so that you can look at job cost. If you have a sophisticated enough, tracking system, accounting system, or whatnot to do job costing, you would assign those materials directly to a job. They would roll up as part of your cost of goods sold. So supplies for the job should be included in that as well. Use tax. If you live in a state where you're paying use tax, then you would also include use tax generally in your cost of goods sold as well. Not sales tax, but use tax. Sales tax is paid by the customer you're selling it to. Use tax is paid by you. So depending on how you're set up and what state you're in and what the laws are in that state, you may have use tax you need to attribute to cost of goods sold. Now, all of those are adds to the cost of goods sold. There are a couple of subtractions from that. One is purchase discounts. So if you pay your supplier on terms and they offer you terms, let's say the terms are 2%, 10, net 30, for example, which is a common term offering, or 5% sometimes in the flooring industry, depends on what it is. If you get a 2% discount and you take that 2% discount, you should be tracking that discount on your accounts payable side. So when you pay the bill, you show the bill as $100, and if you get 2% off, you would show $2 deduction of that goes into these things called purchase discounts. And you should subtract purchase discounts from your cost of goods sold because you didn't pay that much for those goods. You were able to deduct 2%. Therefore, it lowers your cost of goods sold and improves your gross profit margins. And then finally, claims and allowances to you. So if you file a claim against the manufacturer for a defect in product, and they pay you that claim or credit you that claim, the total of those should go against your cost of goods sold for any particular period. And that nets it all out when you add the additions of those that are above and subtract out purchase discounts and claims, you get to the true cost of goods sold. Now, that cost of goods sold then is the second component of gross margins. And we're going to look at the whole concept now of how to calculate gross margins, as well as the concept of markup and margin, which is, again, oftentimes confused. So what I'm going to do now is I'm going to go over here. I've got a whiteboard up sitting here in the studio, and we're going to go over to it for a little bit. And I'm going to just draw out some examples of this and walk you through the steps of how to do these calculations and look at some examples and look at the impact of doing it wrong in terms of calculating gross profit and gross margin. So let's do that. I'll walk over here to the board. We can get me over here. Okay. So the first thing we're going to do is we're going to look at this idea of margin versus markup. Now, again, very, very confusing for most people. They get it, they just get it wrong. And it's not unusual to do that. I mean, unless you've been in the business of sales and you've been trained properly, you might miss this. And it's very easy to do. First thing we're going to look up, though, is the definition of markup. So markup, which often gets used more than margin does, but markup is the incorrect thing to use. It might be useful in terms of just rough calculations on things, but it is not useful in terms of financial statements. And it is not useful in terms of calculating your gross profit, because gross profit is calculated off of margin not off of markup. So markup, basically the formula equals this. It is your profit dollars divided by your cost of goods sold, COGS. So that's a pretty simple formula. You know, markup in terms of the calculation is in terms of percentage, markup is your profit dollars divided by your cost of goods sold. In terms of calculating markup, you can very easily calculate markup from a cost. So if your product is $10 a yard and you want to mark it up 20%, that would be $2 added to 10. So your markup price would be $12. That's pretty straightforward and pretty easy. And you could verify that through this formula that that's 20%. But in terms of calculating, I want to show these two distinctly and separately because they're almost identical. There's only one thing different, and that is the denominator. So profit here equals your selling price, your sale dollars, minus your cost dollars, right? Your cost of goods sold. That is your profit, how much you sold it for minus what your cost of goods sold is, or your cost dollars divided by, once again, your cost dollars, which is the cost of goods sold. That formula, and then of course you multiply that times 100 and you get the markup percentage. Okay, that's equal to markup percentage when you multiply it times 100. Now let me show you the difference in that compared to margin. So margin, again, very, very similar. It is your profit dollars divided by not your cost of goods sold, but your selling dollars, right? Or your selling price if you're doing it on an individual item. In fact, I think I'll just use it that way, your selling price. Selling price, we'll look at it on individual terms. So rather than divide it by your cost, you're dividing your profit by your selling dollars. That gives you a totally different number. So in this case, again, we've got selling price or selling dollars minus your cost divided by your selling price. Okay. And that again times 100 equals your margin percentage. Okay. So there is basically the definitions and the difference between the two. Only difference is the denominator. You take your profit divided by your cost of goods sold, you will get your markup. You take your profit divided by your selling price, and you'll get your margin percentage. And as I said, margin is much more important in financials than markup. Markup does not even play on a financial statement at all. Margin does. It's a part of your gross profit, basically. It is the calculation of gross profit in terms of percentage of sales. And the reason you do that, the reason that margin is used and not markup is used is because all of your other selling expenses are generally on a financial statement expressed as a percentage of sales. So you want everything on your financial to match up to and add up to 100% of your sales dollars. So if you sell $1,000 worth of goods, or let's just use 100, if you sell $100 worth of goods, then at the end of the day, when you look at all of your line items down your financial statement, they will add up to 100% of your sales. If sales is the 100%, everything else will add up to that 100%. And that's the reason we use margin and not markup. So now let's use basically some examples, and I'm going to set some assumptions here just so it makes it easy to calculate. So one of the things I'm going to do is I'm going to establish the fact that we're going to sell a product, selling price of this product that we're talking about, we're going to say is $15 a square yard. We'll use it for carpet. $15 a square yard is our selling price. Our cost of that product, what we paid for it, we're going to just say, make an assumption that it's, is equal to $10. So a $10 product we're selling for $15. That's our example. We're going to now calculate, use the formulas that we have and calculate what that looks like in terms of markup and margin. All right, so markup would be this. It would be this formula, your selling minus your cost. So in this case, our selling is 15 minus 10, and we're going to divide by the cost, which is 10. And what do we get? Well, first of all, we get 5, 15 minus 10, right? And we divide that by 10, so we get 0.50, multiply times 100, and we get 50%. 50% then is our markup on a product that we paid $10 for and we sell it for 15. You could have done that in your head. I realize that. That's real simple. You know, you made $5, you paid 10, 5 over 10 is half, 50%. Real simple, right? But I do it to illustrate it. Now, when you go in to look at margin, let's see how that looks. Watch the difference in this. So margin is now going to be equal to the selling minus cost, which again is 15 minus 10, and divided by your selling price, which in this case is 15. All right, what does that look like? Well, that looks like 5 over 15, which is equal to what? 5 over 15 is 1/3, so 33%. So 0.333, we'll say, times 100 equals 33.3% margin. So we haven't done anything. We've just run 2 different calculations on the same assumptions, a $15 product that cost us $10. We're making 50% markup, but we're only making 33.33% gross margin. Why? Because we're dividing by a different denominator when we calculate margin than when we calculate markup. That's a big difference. And if you're running your business thinking that you're making 50% because you're calculating your selling price the wrong way, well, you're losing tons of margin. You know, and again, I think it's important to understand this. I think it's important for the business owner to know this, but also your purchasing person and whoever is setting the selling prices of your product on the floor must understand this very, very deeply. And also your sales force. If you're allowing your sales force to negotiate prices on product and you're supplying them with cost, which sometimes is done, sometimes is not done, then they need to understand these concepts because they may miscalculate something and cost you a lot of money in your business. So that's the first set of examples that I wanted to use to really get you thinking about how do you calculate markup versus margin. Now, the second thing I want to do is I want to look at how do you set the selling price of a product if you know the cost of that product and your target margin that you're trying to achieve. This happens quite frequently. In fact, with all of the price changes that have happened since COVID started, for example, you've had price increases galore since COVID started with all the supply chain issues that we're seeing, not only in this industry, but across the world. That has continued and it looks to continue for the near future at least. And so you have to adjust your floor prices for product, what you charge for those products, how you price your floor every time you get a price increase notice from your suppliers. And so what I'm about to go through, you have to do quite frequently. And I'm going to show you the formula for that. Of course, if you have a system, a flooring specific software system or other accounting package that'll do this for you automatically, all the better, because it's a cumbersome chore. It can be made easier if you can get electronic information, electronic price files from your suppliers, and you can do this on an Excel spreadsheet. But sometimes you just have to do it by hand, and it's quite cumbersome to do. So let's walk through that process and let you see how you calculate a selling price for a product where you know the cost and your target gross margins. Okay. So the first thing we're going to do is we're going to again make some assumptions here that we're going to say. Let me just write up here how to calculate selling price for target gross margin percentage. All right. So this is what we're going to look at doing. So we're going to make the assumptions are that we have a product price, a price for the product, a cost, I should say. Let me write that correctly. So we buy a product from our supplier at a cost of, we'll use the same example, $10, right? So we buy that product for $10, and in this particular case, I'm going to assume that already includes your freight in. What that is, your landed cost of that product. Now, if you're really looking at this, you could put a factor in here to account for all of those other line items of your cost of goods sold. If you don't do that, if there's no factor in there, no additional cost that you're attributing here to really get to your net cost of goods sold based on what I showed you earlier, then when you look at your mix of products, you add up all of those gross margins, they won't necessarily at the end of the day reflect your true cost of goods sold here. But what most people do is they understand that, and they will set their target gross margins a little bit higher, knowing there's going to be some deductions from that. But in this particular instance, we're going to make it simple. We're going to assume that you paid $10 for that product landed. It's a delivered product to your door at $10 a square foot, square yard, whatever you want to look at. All right. Now, what we're going to also do with this is we're going to set a target margin. We're going to set a target margin, in this case, of 30%, just using some easy numbers that we could use and do these calculations in our head. So $10 product, 30% gross margin. Now, the formula for doing that is this. So the first thing we're going to do is we're going to take we're going to express our target margin this way. We're going to take 1 minus 0.30. 30% is 0.30. We convert 30% to a decimal, and we're going to take 1 minus 0.3, and that's going to give us a factor that we need to do the calculation. And in this particular case, that is equal to 0.70. 0.70. Now, our selling price then is a real simple formula once you know what that 0.7 is. It is simply your cost divided by this factor, 0.70. All right, that's how you calculate your selling price if you have a known gross margin. All right, and so what we're going to do is we're going to look at that. That cost is going to be equal to $10 divided by 0.70. $10 is our cost. 0.7 is the factor we calculated by subtracting 0.3 from 1. 0.3 was our target margin. And that number, when you divide that out, is equal to $14. You can do the math on your calculator and make sure I'm doing it right. And if I miscalculated, you can put it in the comments. $14.29. That's what the selling price of that product would be based on $10 cost and 30% target gross margin. If we were doing markup on this, we would take $10, multiply it times 1.3, and we'd get what? $13. That's a big difference in $13 and $14.29. And so that's how you set it. It's a real simple formula. It's not overly complicated. We can, of course, we can verify that again if we want to. We can go back and look at it and look at our gross margin, and we can say that our gross margin is 14.29 minus our cost of $10. This is going back to the formula that we looked at earlier. How do you calculate gross margin? And then divided by 14.29. And that's going to be equal $4.29 divided by 14.29. And if you do that math, I think you'll come up with a 0.3, you will come up with a 0.30, and you multiply that times 100, and you'll come up with a 30%, which is what our target margin was up at the top. So that's how you calculate selling price of a product. And by the way, this works the same way for labor. So if you're paying, $4 a yard for labor, or you're paying $2.50 a square foot for labor, and you're shooting for a 40% gross margin, you would divide those costs on a 40% margin by 0.6. 1 minus 0.4 is equal to 0.6. If you want a 30% margin, it's 0.7. If you want a 50% margin, it's 0.5. And so the formula gets pretty secondhand nature once you do it a few times and you get accustomed to just simply subtracting 1 minus your target margin expressed as a decimal and divide that into your cost, and you've got your selling price of the product easily set, and you can adjust the prices on your floor. So that, I hope, is helpful to understand the calculations of margin, markup, and how to set selling prices once you know what your cost is and what your target margin are on those particular goods or services. As I said, you need to count for both. Now, as we look at the benchmarks around this, I want to dive a little bit deeper into our business intelligence tool, and I want to look a little bit at some of the margin calculations that we talked about. Look at some norms. This again is some averages. This is two different years. This is 2020 that I'm going to show you on the screen here versus 2021, both first half of each year. So 6-month period ended June 30th in 2020 and 6-month period ended June 30th in 2021. On the left-hand side where it says current, that first column and in the blue there, if you can see the colors on your screen, that represents 2021, first half 2021, and then the brown represents the first half in the prior period, which would be 2020, first 6 months, and then the change between those. This particular chart is looking at all stores that we have data on, which is over 1,000 stores. And it is looking at the cost of goods sold, the components of cost of goods sold for all of those stores. Now, this doesn't break out, store type, store size, business size, or anything like that. This is for all 1,000 stores, and this is an average. So it includes primarily retail stores, but there is a mix of builder business and some commercial business mixed into this. So the margins and the cost and things that you look at might be slightly different from what you might expect in your business if you're pure retail, for example, or pure residential business. So what are the components up here? Well, remember when we defined cost of goods sold back up earlier, we looked at this as to what the components were. You've got as a part of cost of goods sold, your cost of materials. These are the products costs that you paid to your supplier for the goods. And in terms of the total as a percentage of sales, we're looking at percent of sales here. Remember I said that entire amount adds up to 1. So when you look down at the very bottom, the second column where it says current percent, and it's 67.88% there, that tells you that on average, about 67% of the sales are cost of goods sold, all the various components of cost of goods sold. What would that tell you? Well, that would tell you probably got a margin somewhere around 33%. If your cost of goods sold is 67%, then you're going to have 33%. That is your gross margin, or that thereabouts at least. So what are those components? Well, your cost of materials represents about 47.22% of sales. That's the average, again, for these 1,000 stores. About 47% of sales is cost of material itself. And then you have freight, which is 1.4% of sales. And then you have subcontractors at 10.46%. And then salaries and benefits for in-house installers. Remember I said you really need to include that at almost 8% for in-house installers. Now, don't take those two numbers to think that subcontractors cost more than in-house labor. That's not what this is saying. This is based on the mix of subcontractors and in-house labor that those 1,000 businesses are using. And as you know, for the most part, there's much more prevalence of subcontractors than there are in-house installers. But nevertheless, in the aggregate of all 1,000 of these stores, that's what that number come out to be. And then if you look at purchase discounts, those get subtracted. That's 0.5% here. Claims is a very small amount. Supply samples and displays some people put those in the cost of goods sold. Some people put those in marketing expense. It really isn't a huge factor here in the overall aggregate, but you can do it either way. I probably personally prefer that down in sort of the selling expenses line items as a part of marketing and sales expense, not so much as a part of cost of goods sold. But that's not a major factor, not really material in terms of the numbers. Use tax, as I mentioned, just about 0.5%, a little over 0.5% there. And then the cost of sale other, which are miscellaneous expenses they attributed to the cost of sales, is just less than 1%. So when you add it all up, you know, in the current 6-month period ending June 30th of this year, it was just over 67%. And if you look at the year prior, it really didn't change overall much at all. In fact, if you look at the net change column on the far right-hand side, you'll see that there were some adds and subtracts there. Product cost actually, as a percent of sales, went up actually went down slightly. But that's not necessarily because products went down in price. You know, products went up in price. What happened there is probably just mix. And mix affects these numbers greatly. And when I say mix, I mean what percentage of carpet versus LVT versus ceramic and tile, stone and tile and stone, you know, versus hardwood or whatever it is that you're doing. That mix impacts these cost of goods sold quite substantially at times, especially on an individual business. So again, looking at those numbers in aggregate total may help you look and benchmark those against your own numbers. And again, you know, they're hopefully as time goes on, I'm going to take the opportunity to dive into segmenting this data into store size, store type, things like that. We have that data, but on a 1-hour presentation, it's very difficult to do and cover all those bases. Maybe I'll do some publishing of some data on that in terms of an article or something else that can give you specifics. Or we may cover that on a future webinar, don't know yet. But nevertheless, this is the aggregate number that you have out there. Now, back again to the gross margin side of things, looking at the data, looking at the benchmarks that we have. Again, this is based on the first half of 2021 versus the first half of 2020. And this is the gross margin, and it is broken out here by business segment or by store type, really is the way this is. And an individual store identifies themselves as one of these store types: builder, commercial, Main Street, multifamily, retail, or wholesale. They have to identify as one or the other of these. And so if their predominant business is, you know, Main Street commercial, they would identify as a Main Street commercial type dealer if that is the predominance of their business volume, for example. So what you see here in the first half of 2021, you see gross margins of 33 1/3%. And then you see the prior year, it was 32.9 in overall aggregate. Slight increase in gross margins in the overall. Again, you can see the difference there. Retail is much higher. Retail is up around the 37% range in terms of overall gross margin for stores that are purely, or not purely, but mostly retail at least. Whereas, you know, builders down around the 30%, commercial around 30%, multifamily and wholesale, you know, down below that, 27% or so. With Main Street commercial, you know, somewhere around the 34% range. So you can see the distribution of the gross margin. So if you're a predominantly retail business, then you certainly should be seeing gross margins on average north of 35%, somewhere between that 35 and 40% figure. 37 probably being close to the average with the data that we're seeing here. Now, if you've got a much more heavy blend of builder business, let's say you're doing, you know, 30% builder and you're doing 70% retail, you might want to, you know, adjust your numbers and prorate this to that to get some, maybe a closer average to what you might be looking at. But nevertheless, these are benchmark data. This is real data, as I said, from over 1,000 stores. And so it's you know, it's something to look at and compare against in your business. If you're dramatically different than this, then you may have margin leaks somewhere. And we're going to talk about those here in just a second. So let's just go right into it and talk about it now. So there are opportunities to leak margin, places where you might be losing margin that you need to look at, pay attention to, and dive into in your business. Number one is using markup to price your products. If you're using the wrong formula that we went through earlier, and you're using markup when you should be using margin, then you're starting off all wrong. And that don't happen often, but it can happen if you're just not familiar with the terms and somehow or another got started on the wrong foot and you're pricing your products wrong on the floor. Always use margin, not markup. And then accommodations and errors, that's a margin leak. Remember, subtracting from your gross sales, you got to take away all of those accommodations, all those, where you gave an allowance to your customer because something went wrong, some type of error. Those are places where margin leak all the time. It can happen through, your salesperson making an error. It could happen with your installer making the error. Whatever the cause of the error, those are places where gross margin just evaporates, because if you have to accommodate that and deduct from the sales price those accommodations, it lowers your top line as well as compresses those margins, and it's a margin leak opportunity. Sales discounts, this happens on the front end of the sale, whereas an accommodation generally happens on the back end of a sale. The sales discounts happen on the front end, so you're negotiating the sale. Maybe your salespeople aren't trained well enough on how to sell product in without having to, resort very quickly to lowering the price. Oftentimes, that's the way that salespeople want to close the deal. It's all about price. Well, if it's all about price, I guarantee you're going to leak margin. There has to be other ways to sell without having to always resort to lowering the price. I mean, you talk about to that customer, and I'm not going to get into sales techniques, but focus on something else. Focus on how that sale solves a problem for that customer as opposed to focusing on price. Just simple things like that. And I would encourage you, by the way, to listen to Tom Jennings. He's excellent at talking about how to sell in something other than price. We have a lot of webinars. I'll give him a plug here. He does a great job of talking about how you can sell without just reverting to price every single time, because it's not really always just about price. It's about what are the needs of that customer, what will make them happy, and what will give them that good feeling in their home. Focus on the emotional side of it, make emotional connection, and let your accountants worry about the numbers here. But nevertheless, that's where leaks occur. It could be your sales compensation model, because sales compensation can affect greatly if you allow. Here's where it plays in. If you allow your salespeople to negotiate the price that product is sold at, if you allow them to do that, and their sales compensation model does not have some sort of a factor in there that affects their commission, for example, based on the gross margin that they wind up with on that sale, then they may be discounting to get the sale and not realizing the effect on gross margins. So one way of fixing that, if you allow your salespeople to negotiate prices and you pay them on commission, there is, and we may get into this at another session, there is a method of which you can set the sales compensation model that'll help resolve these leak problems in margin. The way to do that, quite frankly, in simplest terms, is do a sliding scale of commission compensation based on either the selling price of the particular product or the gross margin on that product if you expose that to your salesperson. So if you don't do that, if you just simply pay them a commission on the sales dollars, allow them to negotiate the price, they have no incentive to hold the price up. Not much. I mean, yeah, it lowers the top line, but it more so impacts your bottom line when they discount the price all the time. So your sales compensation model could be the point in which you're leaking margin, because you're allowing them to discount product with no financial impact to themselves. That's a hole that needs to be looked at and plugged up. Product mix shifts. Product mix, sometimes we have no control over, sometimes we do. It may be that on products that are more difficult to sell, you can get higher margin on. And it may simply mean you need more training on those products for your salesperson. So understand that mix affects it greatly. It affects your top line dollars, but it most definitely affects your gross margin dollars, because different product categories have different norms in terms of what you can expect to get in gross margins. You make more money, for example, on carpet and hardwood than you do LVT, for example, because LVT has gotten to be such a commodity product. and it's price shopped everywhere, and it's pretty easy to do. But when you look at the other product categories, there may be more opportunities for more margin there. If you can sell more of those products, it'll move your gross margin up, and you haven't sold any additional customers or sold any additional units. All you've done is shift your product mix. Your gross margin goes up, and so does your profitability on the bottom line. So product mix is a major impact, and places where product mix can cause leaks in your margin. Billing errors happens all the time. So that comes from either your back office that produces your billing statements to your customers and creates the invoice from your customer, or it may be your sales force not capturing all of the items on the job, extra items the installers have to do that you got to pay for that you never charged your customer for. Those are billing errors and or pricing errors in the sale and on the sales ticket that cause huge losses in margin. I mean, just huge losses in margin. And then, of course, estimating errors. When you go out and measure the job, you mismeasure, or you miss the fact that I got to move this toilet, or I've got furniture I've got to pay the installer now to move that, my salesperson didn't tell me about when the job was done. And now the customer is already expecting this price. And it's very hard for me to go back and tell the customer, well, we missed that. We got to charge you extra for it. So what do you wind up doing? You wind up eating the cost of the extra labor because you didn't get it estimated right from the get-go. Those are opportunities where margin leaks. It happens every day. If you can focus on these potential pitfalls in your gross margin, you can move that number up. And every point you move that up is a point to the bottom line that you're going to have in terms of profitability. So it's a very important topic. It's something you very much need to look at on and on and on. Now those lines are all on the revenue side. When you look at the cost of goods sold line item, there are places where you can get margin leaks as well. Lag in pricing after you get a supplier increase. So your supplier raises the price on the products. It takes you 2 weeks, 4 weeks to get your products on the floor repriced and get it all communicated. And all that time you're paying the higher prices. Those are margin leaks. You need to be really automated so that you can instantly almost reprice your floor, reprice your product catalog the moment you get that price increase. And this is where B2B comes in a big way. I'll give another plug here. These are shameless plugs, I realize that. But B2B, I mean, that's what B2B was designed for. It was designed to automate the pricing of product communication to you. If you're using, store software or retail or flooring store software, it automatically should feed that into your catalog, and you could hit a button and say, I want to reprice my products selling prices with a click of a button. That's where, those types of technologies improve your business profitability by speeding up and reducing the lag in time from repricing after you get a price increase. Not taking your purchase discounts, you're leaving money on the table. If you get 2 to 5% discount, that's direct to the bottom line based on the percentage that your cost of goods sold is of your selling price. So if your cost of goods sold is 47% of your sales price, then you can take, and you get 2% discount, you can take 47% of your selling dollars, multiply it times 0.02, and you will get how much you could increase in dollars your bottom line by just simply taking your purchase discounts. And then, of course, freight increases. Logistics costs now have gone through the roof. Those are getting passed on. You may or not have adjusted those in your pricing of your product. You need to, because they will eat up your margins in a big hurry. All right. That's it for today. We've looked at margin versus markup. We've calculated our product pricing and target based on a target margin. We've looked at the impact of product mix, margin leaks we've discussed, all of those issues that affect gross profit, both margin and then ultimately it affects net profit in your bottom line when it all falls out at the end of the day. That's what we've discussed today. Hopefully you've got some information out of there you can take back with you and look at your business on and really dive into it and try to stop up those leaks and improve your gross margin line. If you can improve that gross margin line up to where those benchmarks are or even higher, you will do very well. I've seen businesses that have run with 30% gross margins and do okay, depending on what the mix is and how they're structured. But for the most part, if you're a retail business, you should be looking at something north of 35% and 40% is even better. When I look at an average of 37, I know there's some out there making 40 or greater gross margins on retail business, and it can be done. It takes a lot of work in getting the right salespeople. I'll tell you that right out of the gate. All right, that's enough for today. I know we're getting some questions in, and I'll try to answer those questions. If you got a question, submit it in the chat. We've got a few minutes here. I'll stay and get some of these questions answered for you. The first question is, will you be mailing the slides, emailing the slides to us? We will be posting the slides. We will be posting this video along with the slide deck. We will post on our website. So it'll be under the Profit Matters page on our website. You'll be able to get both the presentation in video format, recording of this, as well as the slides that I showed you today. So yes. And then to figure, this next question is, to figure net sales, we subtract the items you mentioned as well as sales tax. Should we look at moving our sales tax to another area? I would tell you that it's most proper that sales tax, since that is paid by the customer, all you're doing is collecting it from the customer and paying it to the taxing authority. That really should be moved down into an expense line item. And truthfully, when you collect the sales tax, you really shouldn't be counting sales tax as a part of your sales, because you're really not getting the money on that. All you're doing is collecting it on behalf of a taxing authority. So what I would suggest you can do is you book that off separately. You show the sales tax collected, which is a liability on your balance sheets, not really an income statement line item at all, and shouldn't even be shown up on the income statement. It's a liability on your balance sheet. And then when you pay that, you're offsetting the liability and just netting those two out on the balance sheet. It never shows up on your expenses, because it's not really your expense, it's your customer's expense, and all you're doing is collecting and passing that on to the taxing authority. Any other questions that you might have, please submit them. I think we've only got those two so far. And if you have additional questions, there's a link on our website to contact us, and you can submit those questions. They will funnel to me, and I will try to answer those back out to you either directly or in future sessions as we have these. We've got another one coming up in December. I don't know the exact date off the top of my head, but I know that we will have another one, I believe, coming up in a couple, 3 weeks in December. Look for that communication as we get ready to send it out. And I don't see any more questions, and we're up against the top of the hour, which we commit to try to get these done in about 1 hour. Hopefully, again, you got something out of it today. Send us questions you might have, comments or feedbacks. You may receive a survey. We're talking about sending a survey out, and we will try to send something out and get your feedback on it. We want to make these better and more useful and more informative for you and helpful for your business. So we appreciate your feedback. Appreciate your attendance today, and hopefully we will see you next time. Well, we got one more question. Hang on. Is there a list of industry standard product margins? Not that I'm aware of, not that is published. As I said, we have access to that data. If you have a very specific question around margin that you want me to answer for you, you could send me that question in the contact us form on our website, and I'll try to get whatever specific, margins I can get for you. So if you'll tell me, for example, what type of business that you have and where you're located and things like that, I can try to get you something more particular, more specific for your particular business if you got that question. But I don't know of anybody that publishes that information. Again, we have access through our business intelligence tool, but I don't know anybody that publishes that. We used to publish that in a report the WFCA did years ago called the Financial Management Report. We've since kind of decided that we would do these webinars to try to fill in some of that, work that we did years ago. The technology has changed now. We have access to much more data than we had before. So I can get the data. It's just so varied and so particular that we can get it. I'd really need to do it on almost on a case-by-case basis. But as we go forward, I may try to share some more slicing of that data. That's my plan, to segment that and give it some little more relevance to maybe your particular business versus just this overall average that I'm showing you today. But love your feedback on that, and we'll try to do that. What about sales compensation model examples? I can send an email. That'd be great. Do that. Send that to us. I actually thought about putting together a separate whole session, and I may do this. In fact, it's on the list of the ones that I want to do, is to talk about sales compensation as a whole entire webinar, where we look at various sales compensation models and how they impact your business, because there's a lot of ways to pay salespeople. I'm just telling you, there's probably at least a half a dozen major ways or more. And I'd love to have your feedback on that, and I can incorporate that in a whole other session. And I will commit to doing that. It's on my list already. So just a matter of getting it in the sequence of things. And we'll dive into sales compensation models. It's a big, big topic. And I've seen some very bad sales compensation models, and I've seen some very good ones. So yeah, we'll be glad to do that. All right. There's no more questions on the board here. So I appreciate again your attendance this afternoon. Look forward to seeing you next time. Look for that communication, and y'all have a good afternoon, and we'll see you then.